All right, let's talk about hedge funds. We're talking about an industry that manages trillions of dollars, and it's all built on a single powerful idea, having an edge. But what is that edge, really? It's not just about hiring geniuses. Nope. It's about winning a hidden, high-tech, high-stakes arms race for information. So today, we're going to pull back the curtain and see exactly how it all works.
So that brings us to the big question. What is a hedge fund's real secret? I mean, is it really just that they hire smarter people who can pick stocks better than the rest of us? Well, the truth is, it's way more complex than that. And it has everything to do with this intense technological arms race for information that's happening completely behind the scenes.
To really get to the bottom of it, we're going to break this down as a tale of two different worlds. First, we'll look at the prize everyone's chasing, something called alpha. Then, we'll compare the tools of an everyday retail investor with the heavy-duty arsenal of a major institution. After that, we'll get a peek inside their alpha factory. And finally, we'll see just how massive the gap between these two worlds really is.
Okay, so first things first, let's talk about the goal. Every single investor, from the biggest fund on Wall Street to someone trading on their phone, is basically chasing the exact same thing. They are all on a quest for alpha.
So, what is this alpha thing anyway? Well, let's be super clear. It's not just about making money. It's about outperforming the market after you account for the risk you took to get that return. You see, a positive alpha proves you didn't just get lucky on a risky bet. It proves you generated real value through actual skill. It is the absolute holy grail of investing. It's the ultimate proof that you have an edge.
And that belief, the idea that you can find an informational advantage, is the bedrock of this entire industry. But think about it. In a world of instant news and global communication, any real advantage is incredibly fleeting. And that scarcity has kicked off this fierce technological arms race to find new, hidden sources of information before anybody else does.
Okay, so let's dive into our first world. And it's a world that's probably pretty familiar to you. The world of the retail investor. Thanks to technology, the tools that are available to the average person today are honestly more powerful than they have ever been before.
And the modern retail toolkit is genuinely impressive, right? You can access the exact same official SEC filings as the pros. You can get tons of free market data and even tap into data APIs. And with platforms like TradingView and even some alternative data, light services, it really can feel like the playing field is leveling out.
But here's the catch. Research shows that all this easy access can be a double-edged sword. One study found that when retail traders got easier access to financial data, their trading volume shot up, but their performance actually got worse. It turns out having all this data can create this illusion of control, which leads to overconfidence and, frankly, more gambling-like behavior.
Now, let's pivot to world number 2, and I gotta tell you, the contrast here is absolutely staggering. This is the exclusive, incredibly high-cost world of the institutional investor.
This number right here, it pretty much says it all. $32,000. That is the approximate cost for a single user for just 1 year to have a Bloomberg terminal. It is the absolute industry standard, the gateway to professional financial data. And that price tag creates a massive, massive barrier to entry. It puts it completely out of reach for pretty much any individual on the planet.
And you know what? That terminal is just the beginning. The real edge comes from something called alternative data. We are talking about non-traditional information that gives you a real-time pulse on a company's health. Funds will buy anonymized credit card data to see a retailer's sales weeks before they're officially announced. They use satellite images to literally count cars and parking lots. They scrape websites for price changes, and they quantify social media sentiment to gauge the public mood. It's a whole other level.
I mean, just look at this table. It puts the two worlds side by side, and the difference is, it's stark. It's not just about having more data. It's a fundamental difference in kind. So while a retail investor is manually reading a public filing, a fund is using AI to analyze every filing programmatically. While you're on your personal computer, they're using massive cloud data lakes. And the cost difference? It's not just a little more. It is orders of magnitude higher.
But here's the thing, just buying all that data is only the first, very expensive step. The real advantage, the true edge, comes from what they do next. It comes from turning all that raw, messy data into a clean, actionable signal inside what we can only describe as an alpha factory.
And this isn't some kind of delicate artistry. It's a full-blown industrial pipeline. It starts with ingestion, basically hoovering up data from countless different sources.
Then comes the really grueling work of cleansing it all, structuring it, and only then can they unleash their machine learning models to hunt for those predictive alpha signals, which are finally fed into automated algorithms to be executed in the market.
So, to make this all feel a bit more real, let's just walk through a hypothetical case study. Imagine a hedge fund is building a case to short the stock of a big fashion retailer. We'll just call them StyleCo.
It all starts with a very faint signal. An automated system, which is constantly monitoring web traffic data, flags StyleCo for a steady decline in visitors to its e-commerce site over the last quarter. Now that's interesting. That's a potential leading indicator that there might be some trouble ahead.
Okay, but that first signal, that's just a hypothesis. Now they need to confirm it, so they query their multi-million-dollar credit card transaction dataset. And bingo! The data confirms the web signal. Not only are total sales down 10%, but the average purchase size is also down 5%, so people are visiting less and they're buying less when they do. Now we add another layer. They have to make sure this isn't just some weird online trend, so they task a geospatial data provider to analyze satellite imagery. The images confirm it yet again. There are fewer trucks at their distribution centers, and on average, fewer cars in their store parking lots compared to last year. The problem is physical, not just digital.
And for the final piece of the puzzle, two more datasets provide context and build real conviction. Natural language processing models scan the web and detect a big spike in negative customer reviews mentioning poor quality. At the exact same time, job posting data shows they've frozen hiring for designers, but are looking for supply chain restructuring experts. So by combining 5 completely independent datasets, they have built an incredibly high-conviction thesis that StyleCo is in serious trouble, long before the official numbers are ever released to the public.
So what's the verdict in all of this? What does it all mean? Well, it means the gap between these two worlds isn't just a gap anymore. It's a rapidly widening chasm.
So it really all comes down to this threefold advantage. It's not just having access to exclusive, expensive data, it's having the analytical horsepower, the teams of PhDs and powerful AI to actually make sense of it, and it's having the operational scale of a factory that can do this process over and over and over again. This isn't about one person being smarter, it's a fundamental structural advantage.
But here's the crazy part. This is a race that never, ever ends. The second a dataset becomes well-known or widely available, its power to generate alpha just decays. It vanishes. This puts funds on what they call a commoditization treadmill. They are forced to constantly hunt for the next, more obscure, more expensive dataset just to stay ahead. The arms race just gets more and more expensive.
And as we look to the future, generative AI is changing the game all over again. The new edge might not be just about better prediction, but about augmenting human intelligence. Funds are now using AI to summarize reports, draft memos, even write code, all of which frees up their smartest people to think more creatively. The winners of tomorrow will be the ones who master this human-AI partnership.
Which leaves us with one last fascinating question to think about. As artificial intelligence becomes a standard weapon in this arms race, the very nature of what an edge is will evolve once again. The question for the future is, who builds the next one, and what on earth will it even look like?
Alright, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.